Hello, ladies and gentlemen, and welcome to our interview with Edward Ingram. Edward has published many academic papers on economic stability, pension fund innovations, mortgage reforms, and he writes his blog named Microeconomic Design. During his career, he was a successful portfolio manager who regularly outperformed the market. And in addition to that, Edward likes teaching young professionals and has been training a team of graduates in the actuarial science area. Edward was also prominent through a series of articles published in the Building Societies Gazette started in the 70s, in which it was stated that a link between the borrower's incomes and the repayments would make life safer for all concerned. Edward, thank you for coming to our interview today. Can you tell us a little bit short story about yourself and what led you to accept our podcast offer?
Thank you, Boris, for having me. The thing is that the world is missing out on a huge opportunity to have a really nice annuity for people when they retire. And they don't even understand that it would be possible to have a defined cost to this annuity, as well as a defined benefit, with very little risk, if any, to mention, to the provider. Now, the provider would be a pension fund, ideally, and what they would do is, in the end, not at the beginning, but in the end, they would be offering a wages-linked annuity for life. So the client will think they've never retired and they won't be afraid of inflation. And the cost of this annuity will be predefined because it'll be defined in terms of the wages index or the wages used in that index. So it would be, say, somebody saved 12 annual wages. They may not be able to save it all themselves. Maybe their company will make a contribution. Maybe they'll sell a house and put the proceeds in to the fund. They may have savings they can put in. If not, then they will get a smaller annuity, but that's life. They'll probably carry on working a bit longer than most, or than they thought they would. But the point is that we can define the cost. If it's, say, 12 annual incomes that's been saved, then you can take an annuity for 12 years of one annual wage, one annual income. And if you do it half that, because you don't have all the costs, you don't have to save anymore, you don't have school fees to pay, you don't have a mortgage to pay. So half that will probably see you through for 24 years at half the income. So this would also be an annuity for life if the customer asked for that. They would work out their life expectancy and give them a figure. So this is something that's astoundingly different and absolutely has a huge demand from the public. So in my blog, I'm appealing to the public and asking them to get us in front of pension funds and get us in front of their trades unions, because I'm sure the trades unions would love to have this for their members, and they will be a huge lobby force in favor. So that's how we're hoping to proceed. And that's why I'm training some guys in actuarial science skills to come on board with me, because I'm old now. I've done other stuff, like I started more or less started the unit trust industry in Zimbabwe when I was there, single-handed. But I was working for an institution. So I've shown that if I work for an institution and it's hands-on, it'll work. I can do it. and they will learn to do it, which is what happened in Zimbabwe. After 16 months, I left them to it, and they just carried on. That's what I'm trying to get people to understand we're trying to do.
Okay.
But there's a second part to this. How will the pension fund provide such a benefit? Well, the answer is they will need to lend the money that they've got for home loans that are index linked to the same wages index. So you may realize, or you may understand, that obviously mortgages are repaid out of incomes. In the past, the lending industry has made the mistake of pretending, well, implying that mortgages are paid out of prices, and they've linked the mortgage to prices index. It doesn't work. In fact, they've done it at times when inflation was high and the prices index was rising far faster than wages. So, surprise, surprise, it didn't work.
So we now in maybe it works for countries with hyperinflation like Zimbabwe, but even in the West world we now coming speedily to probably not on this level, but on a more higher level of inflation. So how this pension will be funded by the even increase in incomes of people? Professionals?
Well, Boris, I want to intervene there in what you said, because you're talking about inflation rising in the Western world. That's not my concern. What matters is that interest rates are very low. Now, with the traditional mortgage, you get what we could call a linear repayment system. It's flat. So much per month for 25 years. That's ridiculous. In 25 years' time, what will it be worth? And if you do it linear, so much more per annum, how do you know how much more per annum to increase it by? You don't. The answer is to do a wages-linked increase, but at a rate that is, say, 4% per annum less than the wages are rising. So what you've got now is an artificial inflation rate, like you're doing level payments with 4% per annum rising incomes. That's the feel that you get. Your incomes are rising like this. Your payments seem to be level. They're actually rising at 4% less than your average wage. So after 3 years, you're 12% cheaper, 12% more affordable. So what does that mean to the lender? Well, the biggest cost that a lender has is chasing arrears. They employ dozens of people to chase arrears. And it's hard work and it's emotionally taxing. And there's all sorts of implications if the customer can't keep pace. And they have to reschedule things. It's all a lot of expense. But if you do it this way, you've more or less eliminated the arrears problem, except for people that lose their income. And you always have that. So the major cost of lending has gone. Now, if you delete the major cost of lending, you become more competitive. That means that you can lend the same amount at a lower rate of interest. So you can always beat the opposition. So the pension fund doesn't need to worry about finding customers. They'll be rushing to join in and climb aboard. And so the trades unions will want this for their customers to help them to buy a house.
And has it anyone tried this before in any country?
Yes. Well, I was the first to discover this this system. And I published it in the Building Society's Gazette in 1974. It was reinvented at Downing Street, and I was invited there, and we compared notes, and their equations were identical to my own. And it was reinvented by two Cambridge academics, and they have got it implemented in Turkey and in other countries where inflation is high. And it's designed to help with high inflation nations where people can't afford to climb on board the system. So it's a low start mortgage. But in the low inflation countries, it is more like a high start mortgage. We start at a rate that is high enough that allows you to reduce your payments every year. But does it have to be high start? Can we compete with the current low start, if you like, very cheap, low interest rate loans that are offering large amounts of loan income multiple? Can we compete with that? Well, yes, we don't want to, but we can. What happens is that instead of having 4% per annum less to pay compared with the index, it might be 3% per annum less, and you can lend a whole lot more that way, or 2% less. But that's really getting a little bit close to the bone. Mm-hmm. But it'll still be with fewer arrears than the traditional method. And the other thing is that traditional lenders are offering fixed interest rates, and that looks attractive until you realize that there's a cost to that. They have to provide for a mismatch where the interest rate rises and what they're doing is no longer competitive on their deposit side. And you have to pay extra interest to cover that risk. Well, with our system, you don't have that extra interest. That risk isn't there. So we can compete with everything that the traditional lender has to offer. Mm-hmm. And so the pension fund will get this asset, which is an index-linked asset, linked to the wages index, which is exactly what they need, whatever they are doing. Because if they are just trying to have their pension fund produce a final salary scheme or something that has some relationship to the final earnings of their customers, this is the asset that they really need. What they've got at the moment is far from this. Every asset, every equity portfolio in the world that has a widespread of investment, which includes pretty much every pension fund, has to hold a bit of this, that, and the other. And the asset value, the price of these equities is at an all-time high. Going forward, they're not going to keep pace with wages. They're going to struggle to make a profit at all. So the more the pension fund can put into this kind of asset, taking the long view, the happier they're going to be. Mm-hmm. So I think it's the ideal asset for the pension fund. Yeah. And I was put onto this actually by a guy called Graham Hollick, who used to manage the pension funds for Old Mutual in his country. And he's got every qualification that you might need, both for investment and for lending.
You have your own blog, so if our listeners are interested in all these calculations, they can go to your blog, which is called named Microeconomic Design. So we don't need to go here with all details, because if they're interested, they can go deep into your blog. But I just wanted to know, if this principle can be used also for business loans, or it mostly applied for mortgages? What do you think?
Yeah, well, I was interrupting you there I was saying macroeconomic design. It's not micro, it's macro.
No, macro,
It's
macro,
the big stuff,
macro,
not
yeah,
the little stuff.
macro. Sorry, my pronunciation is not good. Yeah, I meant macro, yeah.
A lot
Macroeconomic design.
a lot of people hear micro, even if they
Oh,
say
yeah,
macro.
yeah, macro, yeah.
So
Macro.
it has to be emphasized.
We will
Okay.
create
If they
a
search
link.
that,
I will create
if
a
they
link
search,
to the
yeah,
in the show notes to your blog. Okay.
yeah. The words are written in capital letters, and they'll find it on a search. So that you're now asking about business loans. Well, yes, business loans. There's many kinds of business loans, but I want to talk about one in particular, where there's a startup or an extra part of the business that's being created. And the businessman puts his property up as collateral. And typically, they want to borrow, say, 65% of the value of the property, which has got no mortgage on it, maybe. So there's a 35% deposit there. And the bank will say, yes, we will lend you at this rate of interest, capital and interest repayable over 10 years or something like that. And the businessman will have to accept this because there's very little choice. And they will find that whilst they're starting the business, they're still paying the capital and the interest. And what they can actually invest in the business is probably only about half of what they've borrowed. The rest is used to service the loan. But if instead we do a wages-linked loan, then a lot of the interest is carried forward in the index. It's reinvested in the index. And it's only the marginal rate of interest, the bit that's over and above the index that we're charging, that has to be paid. And that gets to be quite small. So that might also be rolled up so that your loan becomes not 65%, it might become 75% of the property value, especially if the property is still rising in value as well. And that's not going to do any harm to the lender. And it does mean then that 100%, all of the money that's been borrowed can be invested in the business. So I think there's a big advantage there. I'm sure that other forms of business loan can take advantage of similar ideas. But I'm not an expert in every kind of business loan. Mm-hmm. I'm just saying here you have something that you can use. So how do you like that, Boris?
Yeah. It's interesting. For me as a business professional, certainly I would like to have loans that more without repaying this bigger portion of it usable for me, not for the bank as a service cost, right? So let us go to the pension scenario for a minute. And you say that pension funds will be restrained in how much that they can invest in this kind of wages-linked lending. Would you mind telling the listeners about that, a little bit?
Yeah, well, when I spoke to Graham Hollick about this, he was telling me that only 20% of the fund can be invested in mortgage-backed securities or in property, and that is a restriction. So then the pension fund will have a dilemma. Should they offer these wages-linked annuities to 20% of their customers, or and what will they do with the other 80%? Will that be fair? They may think, no, that's not fair. And then they will just have to use that asset to calm the performance of the overall pension fund. Mm-hmm. But as soon as people begin to realize that this restriction is doing that, there's going to be pressure on the regulators to lift that regulation, because this is the safest form of investment that a pension fund can make. Pension funds are normally required to invest in certain kinds of assets like fixed interest bonds from the Treasury. Those are dangerous when it comes to inflation. Okay, it helps the government to write off some of their debt, but it's at the expense of the pensioner. But I've got a suggestion to the government. You see, this new lending model can be so designed that it stabilizes the property market. The property market, when it inflates and busts, is the leading cause of a recession. And if we can stop that from happening, this will certainly assist in that way. And if you want to know more about that, I can talk about it at another time.
Yeah, absolutely.
But that's a part of the second part of my work, which is how to manage the economy itself. The government will actually find that if they want to borrow money, it's probably cheaper to deliver to the market the asset that they're looking for than it is to offer them a fixed interest rate. They'll probably get a better deal that way, in fact. So they could offer bonds that are wages linked for the lifetime of somebody or forever. Mm-hmm. And the pension funds could buy that asset to give an annuity for life. They can offer 10-year bonds for temporary annuities, 20-year bonds. The government then won't have to roll over the interest all the time because it rolls over itself.
Okay, interesting. So let's finalize. So if I know I asked this question of all of my listeners, because you are also a long-time member of our community and you contributed in the past to our blogs and even almanac that we issued a few years ago. And I wonder what is your opinion, how we can contribute better to this complex world of risk management?
Well, I'm just hoping that your listeners will contact me if they have any questions. My contact details are on the blog. And if there's anything they want us to help them to implement, let's do it, because I'm used to implementing things. As I said, I've done it for the unit trust industry. I've done it for myself in my own way of investment management. And I've always concentrated on downsizing the risk in the investments that I've done. Mm-hmm. If you minimize the risk, the only way the investment can perform is up.
Yeah, this was about your I understand that we will provide the link to your blog. But what do you think, how we can improve inside global risk community what we do so more people will be engaging in these conversations? Do you have some opinion on this? Because only some serious senior people like you mostly are involved, and the majority are quite absorbing information. We don't hear from them, you know.
Well, I'm just saying to them, look to your own self-interest and get a lobby going. Have a word with your trades union, get them to talk to us, get them to have a look at this interview. And anybody that you think will help to get your pension fund into a better shape, because people are really worried about their pension funds today, and there's a good reason for that.
Okay, fantastic. Okay, thank you, Edward, for your talking with us and providing your very unique opinion. And I think it will be very interesting to see how it will be developing, and you teaching your new graduates. So I hope it will be after our interview, more people will come to your blog and maybe ask you direct questions, and probably maybe you can get some deals from pension funds. Thank you.
Okay. Do you want one afterthought?
Yeah.
Governments sometimes have houses that they want to rent to people, and sometimes they'd prefer to sell them. Well, using my lending model, they can use what we call rent to buy. So the early payments, no deposit, are rental payments, but they're higher than the normal rental payment. They're at the same level as the mortgage payment would have been. And so the extra money goes towards creating the deposit that they need. When there's enough deposit, they convert to mortgage and they buy it. They will not notice any difference in the payments. It'll be just the same as if it had been a mortgage right from start to finish. But the lender won't be at risk because they're accumulating the deposit. If the rental person can't afford the rent, then they deal with it in the same way that they would have dealt with it had it been rented in the first place. So rental housing can become owned housing if the government so wishes to use that route.
Mm-hmm. Okay, fantastic, Edward. Thank you for this afterthought. And I know that with some countries, they did the privatization, and a few former rental houses became their own houses, or especially countries from Soviet bloc when they were Soviets, so they were kind of all rental, but then they became private. So this is another way. All right, thank you for this episode.